In our last quarterly review, we compared the swoon in market prices to a pendulum that had swung to an extreme. We were of the view that markets were near a reversal and positioned our portfolio accordingly. Since touching their lows in mid-March, North American equity markets have staged impressive rebounds. The Dow and S&P rallied 11% and 15% respectively, while the TSX was up 19%. Excluding resources, the TSX rose 21%. During the quarter, the Agilith North American Diversified Fund staged a 48% recovery and is now up 42.5% year to date. This brings the fund's trailing 12-month returns to 16% and our returns since inception to minus 4.8%, a performance that is well ahead of the declines registered across North American indices. While the past quarter has shown an impressive turnaround for markets, we believe that there is reason for continued optimism when looking forward, as many of the metrics that pointed to a reversal remain at extremes. The chart shown here graphs lagged 10-year returns for both equities and 30-year treasuries. What we think is notable is the extreme drop in the lagged equity returns over the past 5 years. Essentially, long-term returns on equities are near 70-year lows. Moreover, the recent rally in equity markets has done very little to normalize the relationship, either to historic returns or the current lagged returns in bonds. We don't believe that this extreme is sustainable. In addition, money market funds, which essentially represent cash on the sidelines, also remain at historic highs. While it's not difficult to see that there are many extremes in the market, the trick is identifying what's likely to cause the pendulum to change direction. We believe the next driver of market returns is earnings. With this in mind, we think it's worth examining trends in the yield curve. As shown in this chart, the curve was reasonably flat, leading into the technology bust and subsequent economic downturn at the beginning of the decade. It steepened substantially in advance of the recovery, but gradually flattened out as the impact of easy foreign capital depressed long-term rates, even as the central bank was raising short-term rates. The curve actually inverted at the beginning of 2007, an early indicator of a coming economic slowdown. It gradually steepened throughout 2008 and is now at more normal spreads between short and long-term rates, indicative of longer-term growth expectations. A number of economic indicators are also supportive of improving business conditions going forward. The Conference Board's index of leading economic indicators rose 2% between December 2008 and June 2009 versus the 3% drop registered in the prior 6 months. Also, the CEO Business Confidence Index rose to 55 in Q209 from 30 in the prior quarter and represented the first quarter since 2007 of more positive responses than negative. The bottoming of this index is correlated with improved capital spending, likely sometime in the second half of 2009. Also, we point to the Manufacturing ISM report on business, which bottomed in December 2008 and has shown steady improvement in the first half of 2009, another harbinger of improved business conditions going forward. Improved business conditions and stronger GDP growth, combined with the leaner cost structure that many businesses are now operating with, should lead to accelerated earnings growth. In fact, consensus estimates now forecast more than 20% growth in S&P earnings in each of 2009 and 2010. Yet despite this growth, market multiples remain muted, with the S&P trading at less than 15 times forward earnings, implying that the market is skeptical of current forecasts. Looking back, there is certainly cause for skepticism, since forecast earnings for 2009 and 2010 steadily dropped throughout 2008. However, we note that the revisions to forecasts have stabilized over the past 3 or 4 months and have actually increased slightly over the past month. We believe the current earnings season will be critical in confirming this trend. Prior to making any investment, we urge you to read through our offering memorandum, which you can obtain either by contacting us directly, going to our website, or clicking on the link attached to this presentation. Thank you.